Are we heading into a recession? Let me know down below in the comments section. I will share my thought process with you guys. I will share some of the risk factors out there, whether or not we could be actively running into a recession. I would like your opinions down below in the comment section. Indeed, a potential recession would have very negative impacts on AMC stock, on our broader markets. Just not a pretty situation overall if that were to happen. So, what are the odds of that? Well, according to the markets, around 70%. And what you seen on Friday was markets pricing in a lot more rate cuts, right? We went from pricing in 5 rate cuts to 6, almost 7 over the past really 2 days or so. Even a hotter than expected inflation report on Thursday, the markets still priced in more aggressive Fed rate cuts. Why does that happen? Well, you could make the argument the only reason that would happen is if someone somewhere knows something about the economy that general markets do not, that things could be weakening faster than some people think. So let's get into that topic. I do want to go do something pretty interesting. Best case, base case, worst case scenario analysis for AMC stock over the next 6 months or so. Like, how bad could things get? What do I expect things to do? And what's the best case scenario over the next 6 months? Now, the best case scenario is always relative because you could always see, new all-time highs. You could always see a stock go infinitely higher, and that's much harder to predict or look at than the, possibility of the best or base or worst case scenario. So let's get into it, guys. Hit that like button and subscribe to the channel. Let me know what you think about this information down below in the comment section. So to my point of what I was making, one of the most interesting things that has been happening recently is you are seeing an uninversion of the yield curve, the 10 and the 2-year, mainly because the 2-year treasury fell a lot on Friday. Now, two-year treasuries don't mean much to the market or for financing. When you go to get a car or a house or really anything else, 2-year treasuries, they're not it, right? 10-year treasuries are the reference, right? The common denominator, if you will, between what to lend money for. If you can get 4% in a 10-year treasury, you're not going to get a mortgage for 5. You're going to get a mortgage for 7. All right. If same thing for cars. If you can get a 7-year car loan or 5-year car loan, 10-year treasury is paying you 4%. You're going to be paying a lot more than 4% adjusted for risk and depreciation of cars. Then your interest rate could be much higher than that, right? We could get into the semantics for an hour long, but point is, 2-year treasuries are directly tied to Fed policy, implied Fed policy. So when the 2-year yield actually moves, that's when you get big moves in bond market expectations. So last week, we had a hotter than expected CPI report on Thursday. The markets priced in more aggressive Fed policy. Thursday, you were really pricing a recession, if you want the nutshell of it. A hotter than expected inflation report. I would expect the probability of rate cuts to fall, maybe even a little bit, maybe a lot. That did not happen. The odds of more rate cuts increased a lot. And then what happened on Friday? You had really good PPI numbers, but PPI is not a huge deal in the grand scope of things. What happened? 2-year treasury yields plummeted. This could be, in a weird way, not saying that, 2-year treasury yields are plummeting because of inflation falling, producer prices falling, but actually because producer prices falling could be a sign of trouble to come for the economy. Because, typically prices falling means people start to get laid off. Now, when that's actually reflected in CPI data, that's where things get a little bit more obvious. That's when the layoffs would actually start. But, what you've seen over the past couple of days is very strange, okay? Not very good. Now, the yield curve. So the yield curve on Tuesday, before anything really happened, was inverted 34 basis points. On Thursday, you were inverted 28 basis points, so you uninverted a little bit. Again, 2-year treasuries fell on the inflation report. The market's priced in more aggressive Fed policy. That should not have happened regardless. But take a look at Friday. Friday, the yield curve is only inverted 18 basis points. The last time we seen this steepening of the yield curve was back in October, November, really October of 2023. And that's when stocks hit their lows. Overall, you declined about 10.5% on the S&P. And that, was coincided with the yield curve uninverting. Well, you can make an argument that hasn't happened now, that maybe that means we're likely due for a larger pullback, and I think that would largely be correct. Now, let's take a look at the 10-year, 3-month yield curve. This is where things are just strange, just outright strange, okay? Because you were inverted about 1.88%. Now you're only inverted 1.49%. Back during October, you've seen a much larger steepening of the 10 and 3-month yield curve. What's interesting here is the 3-month bond is very sensitive to Fed policy, like directly sensitive to Fed policy. So what the markets are pretty much saying here is we're not expecting massive cuts in the next 3 months, but we are expecting some pretty aggressive cutting over the next 2 years, which, implied for risk premium and the factor of bonds, right? That's really implying a lot of rate cuts over the next year or so. It's a little bit harder to predict 2 years out the line. So when markets are predicting off the 2-year treasury, they're really looking out like 1 year, right? So not a lot of rate cuts in 3 months, but 12 months from now, that's a different story. 6 months from now, that could be a little bit different of a story. So when we get the next Fed meeting on January 31st, it's going to be very important to pay attention to what these yield curve inversions do. You're starting to get a lot more people talking about a potential recession. Take a look at this. This is something I found pretty notable. Job openings are collapsing, and this is no surprise. We already know this. But when this happens, you tend to go into recessions. Now, this was happening from 2018 through the start of the Rona, right? Job openings started to fall. You were probably going into a recession either way before the Rona happened. The yield curve did invert in August of 2019, but the Rona happened first, so that kind of, happened quickly. But point is, when you see job openings decline, typically you head into a recession. So I find that pretty compelling. Job openings are a lot higher than they were before, but you could also make the argument that there's a lot more immigration, there's a lot more people in the US, so that's not as telling. Now, credit card spending has also collapsed. So you're actually negative about 5% for credit card spending, and this is lower now than pre-pandemic levels. This is a weird one, kind of hard one to wrap my mind around, because just there's a lot of money out there now. People are spending a lot of money. Credit card debt is rising. But I think it's more so the percentage change of credit cards itself. Now, this one says the probability of a 2024 recession is at levels only seen 2 times since 1960. Both ended in severe recessions. This time is not different. And of course, this chart is from Game of Trades. And that's pretty spot on. It says the probability of U.S. recession predicted by yield curve 12 months prior, you're at about 70%. You're higher than the 70s recession. You're higher than the 80s recession. Well, not higher, but getting close to some of the high points you've seen during the 80s recessions. And these were pretty rough, back-to-back recessions. You're a lot higher now than you were before the Rona. You're a lot higher now than you were during the 08 period or the dot-com bubble. So in recent times, you've never seen anything like this in terms of probability for a recession over the next 12 months. So that's not exactly great also. Definitely something we want to keep our eyes on. And JP Morgan's asset management says it's reasonable to expect 150 basis points of cuts coming next year. That would be like 6 rate cuts, right? So that would be some form of recessionary environment. Just based on what markets are pricing for Fed policy right now, 6 rate cuts, you're pricing in a recession. 7 rate cuts, almost being priced in, or pretty close to being priced in, you're pretty much pricing in a recession. Unless inflation were to just plummet and start to go negative, then you're pricing in a recession. That's the bottom line to it, especially since we've seen CPI come in hotter than expected on Thursday. That is a little bit on the troublesome side. I'm not going to lie to you guys. That's not exactly the greatest situation that we are being faced with. Now, with all of that being said, what do I personally think? Honestly, I don't know. I'm not a fortune teller here. I see certain sectors of the economy that have been in a recession for a while. I see student loans just restarted, student loan repayments. About 60% of borrowers are not making their start of their payments. People are struggling. Credit card debt is at the highest levels it's been ever. The interest payments that people are spending also are like double what they were pre-pandemic. Now, interest payments, compared to principal, right? Interest is going to be smaller than principal most of the time. So, people are still okay as far as household balance sheets. But I mean, when you look at all the corporate layoffs that we're seeing, when you look at how people are fearful out there, just Google on Friday laid off like 1,000 or 2,000 workers, something like that. You're not seeing the greatest signs from corporate America out there. Now, there are some good signs, though, like the fact that insiders are really not selling stock at abnormal paces at all, right? And maybe this is when it sucks having too many tabs open, because it's here. One of these tabs is the right one. I was just on it too. That's the messed up part. Either way, it's here somewhere. Let's see if we can get this pulled up for you guys in just a second. But CFOs, CEOs, they're really not selling stock, right? And that's a pretty good sign, because when they start to sell stock is really your moment where you have to say, hey, we might have a problem here. And you could see insider buy/sell ratio for the entire markets sitting at 0.25. Very low historical levels, right? Very low historical levels. If you look at CEO insider buying and selling, very low levels. If you look at CFO insider buying and selling levels, very low levels. Now, typically, this tends to happen or spike before or during a recession. People tend to sell more stock for one reason or another. What runs supreme during recessions? Death, divorce, default, right? All of those things would be great reasons why you would sell stock. So a couple, things that look better, some things that just look outright bad. I think one of the biggest risks we have right now, though, is the Fed being somewhat delusional here to say there's still more work to do on inflation, that inflation, can continue to fall. And that's true, but it's going to take some time. Housing, the Fed's not helping that. Rents, the Fed's not helping. As the Fed keeps rates higher for longer, they're actually hurting inflation. They're actually causing the inflation, because if people can't refinance to get a lower monthly payment, they can't charge less for rent, right? They have to charge more for rent. So believe it or not, it almost makes you wonder if the Fed knows this, but they're actually the ones that is causing housing inflation right now, because housing inflation was not a thing really for most of 2021 and the beginning of 2022. Housing inflation just really started in the second half of 2022 and 2023. Most of the inflation we've seen previously was in goods. That's gone. Services, starting to see a lot of deceleration there as well. So those are certain things that I'm looking at. Now, why this is important is because whether or not we have a good 2024 for AMC or any other stock, or just the broader markets, is whether or not we enter a recession or avoid recession fears. If we get recession fears, then stocks are going to do very poorly. If we go into recession, stocks are going to do even worse. So what I mean by recession fears, what you've seen on the S&P 500, back here or so, when you hit the lows in October of 2022, when you hit the lows again in October of 2023, these were caused on recession fears, right? More recession fears back here in 2022 in October, but still recession fears in October of 2023. Recession fears give you most of the downside in the markets. If you actually go into a recession, that's where you can get a lot of downside as well. So That's something I'm also considering. But at the same time as all of this recession talk, it seems like we're actually, we've been in a rolling recession, that maybe the economy actually accelerates. At least that's what the recent data has been showing us. But then again, that's government data. And how much can you actually, respect that? It's government data. It's phony baloney, right? That's why I think earnings will be very important this time around, not just for valuations, but to get a sense of how people are actually doing out there, how the economy is actually doing. Now, earnings growth for the S&P 500 is expected around 11%. If you come in anything less than 11%, stocks are going to get beat up coming here in this year, and that's for Q4 earnings. Anything less than 11%, it's not going to be great at all. Valuations could be higher than we think, but in the reality, that would just say the consumer probably starting to slow down. And you are seeing like the 50-cent VIX trader we talked about in the last video. People are starting to make some of those, weird, mysterious bets on our markets that, stocks are going to fall. So we'll obviously see there. That's a little bit more on the speculative side. But if earnings come in poorly, that's going to be a big problem. We want to watch any and all economic data, including inflation. If that starts to get worse, things are not going to be good for our markets as well. Now, specifically with AMC, this all sucks because, stocks are trading at all-time highs, right? Odds are the next move is going to be lower. Unless earnings just come in and blow everyone's mind, which I doubt is going to happen, unless the next inflation report, which is about a month from now, comes out and is just stupid good. I don't see that much upside for broader indexes, at least in the near term, right? Towards the second half of 2024, maybe that's a different question, but still, you're at a place where stocks are at all-time highs. AMC stock is at all-time lows. If things get worse from here, AMC stock will fall, and it will get worse. So my worst case scenario would be the markets start to go into the cycle of bad earnings, fear about the economy, and fear about a recession. The ultimate worst case scenario, and maybe that would take AMC down to like $3.50 or so. Just recession fears overall, markets not doing great. If markets were to like full on crash, you could go to $3, potentially $2 per share, right? You understand, but that would probably be short lived. If that happens, the worst case scenario, plus AMC dilutes shareholders. Let's say their timing's bad again and they dilute shareholders 2 weeks from now, stocks fall or whatever. Then AMC stock could go under $1. That would be the worst case scenario. Dilution and a market crash and or recession. AMC stock's going to be $1 stock. That's the bottom line to it. The 100%, in my personal opinion, I'm not a financial advisor, maybe not. Maybe AMC rallies off that in a perverse market that we live in. Maybe that's possible. But I think the highest probability would be AMC stock would probably be under $1 per share. Now, for the best case scenario, that's obviously infinite, right? A logical best case scenario, if AMC gave us a commitment not to dilute shareholders and the markets avoid a recession, money comes back into small and mid cap stocks and everybody's doing well, then AMC stock could easily make it back to the $40, $50 levels. That could definitely happen, especially if AMC's fundamentals, do good and really come in as good as they possibly can, right? It's a possibility, right? And it would obviously take a little bit more than that, but I'm being overly simplistic. Now, in my base case, I am expecting some recession fears at some point. So I am expecting a larger pullback, maybe a 20% pullback at some point in 2024. My hunch is at least in the first half. Now, just so you guys are aware, there's only been one president that has ever won a re-election during a recession, or if there has been a recession 2 years before a re-election. So that would be like from 2022 until 2024, right? If there was a recession in 2022, 2023, or 2024, your odds of recession your odds of getting reelected are very, very low. All right. So the only president that has ever done that is William Taft in 1913. And there's been 8 presidents that have tried to get reelected under that criteria of a recession that have failed. So your precedent for getting reelected is not great if you lead your economy into a recession. So I think the Fed would do everything possible, potentially even cut rates down to 2%, 1%, 0% to avoid a recession if that is the direction that we start to go in. Now, to get recession fears, all it's going to take is one really bad jobs report. One really bad jobs report, and people are going to start selling stocks in droves. And again, because stocks are all-time highs, that is a problem and that is a risk. It's going to be a lot worse if we get a terrible jobs report and stocks are up here relative to a much lower level. So that is definitely something to think about as well. So a base case scenario, what I think is actually realistic, is I do think Adam Aron will give us a commitment to not diluting shareholders. I think that will happen, but I think you also get recession fears at the same time. So without any short squeeze, without anything too crazy, I expect AMC stock over the next year could hit $15 to $25 per share, maybe $30 per share. That's just based on the company doing okay, doing good, some capital coming back into our markets in the second half of the year after recession fears in the first half of the year, and again, a commitment to not diluting shareholders in at least the first half of the year. If it's just the first half of the year, then AMC stock could fall, quite a bit by the end of the year. We'll have to see. But these are only just rough guesses, estimates. Let me know what you think down below in the comment section. What is your best case, base case, and worst case scenario for 2024? Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.